green economy has become a priority for governments and companies around many parts of the world, and investors are certainly listening. As people look for ways to be more sustainable in their everyday lives, investing in sustainability is an avenue you may want to consider. I'm pleased today to be joined by Portfolio Manager Anna Lester and Institutional Portfolio Manager Mike Hagopian for a look at their sustainable investing methodology and for a bit of an update on the Fidelity Sustainable World ETF and Mutual Fund. Welcome, Anna and Mike. Great to see you both. How are you?
Good. How are you?
Terrific. Yeah, great to see you again. And we'll invite everyone who's seeing you right here today to send their questions in over the next half hour or so. Be happy to put as many of those as possible to Anna and to Mike here today. Mike, I might ask you to just bring us up to date, remind us, how does this fund ultimately work, sort of the methodology that we just spoke about there? Give us sort of the ABCs.
Yes, the Fidelity Canada Sustainable World Fund, it's actually coming up on 5 years in the market. We launched in mid-2019. It's a portfolio that is, it's a global equity portfolio, so it has both developed and emerging market exposure. And it's really looking to achieve three main objectives. We want to build a portfolio with very similar characteristics to the MSCI All Country World Index. So this is going to be a core equity exposure that we've built. So very similar sector, country, market cap exposure as that index. But the second thing is we want to do that in a way and build an attractive sustainability profile relative to that index. So advantage from a sustainability viewpoint versus MSCI ACWI. And we want to deliver performance above the benchmark over the long term using our investment process to make stock selection decisions. So what we're doing is we're being sensitive to an investor's concern about how they're generating investment returns. And an investor can take comfort in knowing that they're not profiting from the sale of controversial weapons in our portfolio, that their energy investments are aligning closer to energy transition and minimizing climate change. But again, we want to provide a portfolio that can be used in the broader context of that core exposure from an asset allocation perspective versus something that's just a thematic satellite.
Fantastic. So interesting. And I'll ask you to bring us up to date a little bit on the regulatory landscape. We don't need to go into all of it, but things have changed. And actually, when we spoke last, things were changing then as well. Companies have had some time to get up and running. I assume there's a little further to go. Just give us a sense of where we are in this. What's new? What's happening?
So there are a lot of interesting things happening on the regulatory front. I think the most interesting is that there will now be regulatory controlled disclosures around scope 1 and 2 emissions. And what's so important about that, especially for us quantitative investors, is that we need consistent, standardized data that we can compare across companies. And when it's regulated, that makes it a lot easier for us. And I think a lot easier for most investors to really understand the emissions data. However, this will take a few years. This will be somewhat difficult for smaller companies. So larger companies will start to disclose sooner. It'll take smaller companies have a few more years to start to do this. We still have a long way to go. We do not have scope 3 data.
Just remind everyone what scope 3 is. This is sort of when we get into the supply chain and where everything's come from, isn't it? And that's often a global process.
Yes. So when you have scope 1 and scope 2 emissions are, the emissions that are coming from directly from your business. So a utility company has emissions generating energy. A real estate company uses the energy coming from the utility company. That's scope 1 and 2. Those are pretty straightforward. Now, scope 3 is actually much more interesting because that's where you're looking upstream and downstream. Let's say you have an auto company. It's the emissions of the companies that are producing the auto parts that the company's buying. Downstream, it's the emissions of the cars that the auto company has produced. And so you get a much more holistic view of the overall emissions of a company when you include scope 3. But as you can imagine, that is a lot of data. Yeah. And that is very difficult for companies to collect. And so it's no wonder that it's taking time for regulators to want to see scope 3. But from an investor point of view, this will be extremely valuable data. And I think small companies, it will be a little more challenging for them. But I think This is critical data that investors need.
Well, it's fascinating too, Mike, because it allows you to look at the data within a company through extra lenses, many different lenses, and probably many new lenses as well. Speak to how that sort of allows sustainability or perhaps some version of diversification to the investment itself.
Yeah, when we think about building this portfolio, one of the first steps is to define what are sustainable leaders. So the opportunity set that we have is about 3,000 securities when we think about that all country world index, that global index of developed and emerging markets. We actually bring that opportunity set down to about 1,200 securities. From then, we actually start to do some of our systematic analysis of these companies to understand which are more attractive relative to others. But thinking about just getting from that 3 to that 1,200, what's getting screened out? These could be companies that are facing severe controversy. So a company like Boeing and their product safety issues, not something that we would consider investable from a sustainability viewpoint. Companies that have significant revenue sources from tobacco, or maybe they manufacture controversial weapons. Another example of things that are going to not make it from that 3,000 to 1,200. And then more broadly, I think this speaks to more of like where that data comes in. We're looking at a third-party provider that will rate companies across a variety of metrics, their environmental, social, and governance. They'll be scored based on some of those metrics, and that'll additionally exclude names. From that opportunity set, we then apply what I'll call our alpha insight there. So that's driven by a systematic research-driven approach. We're identifying long-term drivers of stock return. So these are things that are rooted in economic rationale, supported by empirical evidence our research team does. So things like valuation, growth, quality within these 1,200 companies we're looking at. Also some non-traditional measures of a company's potential future returns. We're combining those, we're scoring all those companies, and we're using a disciplined portfolio construction and risk management process to maintain that core equity exposure, that semblance to the index. So we're going to have very similar energy exposure to the index, but we're going to be holding names that are better positioned for clean energy transition, or some that aren't necessarily as carbon intense. And that's where that data comes in to help us make that delineation between some of those securities as well as part of that screening process.
So, Anna,
so we end up with a portfolio of around 200 to 400 names.
200 to 400 names. And Anna, did you want to just add to that too, again, the idea that this information is more available and that you're able to apply it and use the metrics that you want to use with reliable data that's coming through?
So the quality of our model is very dependent on the quality of the data that's coming in. When I started as a quant 25 years ago, there was very limited data, and my job was to squeeze out as much information as possible. Now the data has become much richer. There are thousands of data providers out there. So I really have to sort through and figure out what is the valuable information, what is not valuable, but still the quality of the data really determines how effective it is in our process. And some of the techniques we use machine learning and natural language processing, some more modern techniques. They are very dependent on high quality data. But once we've cleaned that data properly, these are some of the most exciting additions to our process in the past few years.
Fantastic. Mike, do you want to pick that up? Because we're going to talk about AI right here, and a couple of different approaches that I think you can talk about with it.
Yeah, well, I'll talk maybe from a couple different lenses. Artificial intelligence, just generally for sustainability and what we think about in our portfolio. So, one of the contributors to artificial intelligence has been the improving technology and the expansion of the semiconductor industry, and we certainly have semiconductor exposure in our portfolio. I think what's interesting about this space is there is sustainability impacts that we need to think about in terms of what names we're going to hold in our portfolio. So the production of semiconductor chips, that can be a fairly water intensive process. And some of the fabrication takes place in water stressed areas. So Taiwan or China are two main sources of semiconductor fabrication. So this, from our portfolio's perspective, when we think about it from a sustainability lens, there could be higher scrutiny when it comes to water stress in terms of semiconductor production that may disrupt some of the capabilities or production of these companies. It could increase costs for these companies. So it's an important screen to think about when we're thinking about looking at going from that 3,000 to 1,200, some of those more sustainable companies that we can then do further analysis. So, as an example, there's a large fabricator in Taiwan that we have as part of our investable universe that's passed those screens. And that's because they're putting forth investment and potentially meeting those future demands. They're investing in developing water recycling or reclamation plants with the goal of actually reusing a lot of the water, not necessarily draining some of that freshwater supply. So I think that that's important from sort of a sustainability, AI, what's its imprint on this portfolio. And then also the other side of AI is sort of the benefits of it, right? So the improved technology can create a more sustainable future for ourselves. So if we think about AI contributing to more efficiencies in managing the power grid or helping to forecast weather, that can help turn off whether we're going to be relying on solar or wind production or potentially need to turn on more traditional fossil fuel burning ways to meet electricity demand. So optimizing the heating and cooling of buildings, I think all of that is the potential of AI as well. So two different perspectives. I think it helps us in terms of meeting our climate goals, but then also we need to manage that in terms of how we're getting there.
Pamela, I can actually add to that.
Go ahead.
Because we're not just sort of using AI from that perspective, we're actually doing some of these more modern techniques as part of our stock selection process. So I want to give you an example of how we use natural language processing. And this can be helpful both for stock selection, but also for anyone at home, especially if they have a small child. So let's say you have your child comes home, had a math test, and you say, how was the test? If your child says something along the lines of, fine, I got a 90, simple, straightforward, it's probably good news. However, if your child starts to say something along the lines of, well, the teacher didn't explain the subject well, and I didn't have enough time to, and
how many people are laughing right now because I relate to this? Yes. Okay.
So exactly. The rambling means something's wrong. The thing is, just like a small child, company management is the same. When they communicate, and there are many ways they communicate, earnings calls, financial statements, anytime management speaks, we're able to evaluate, are they speaking simply or are they rambling a little bit? And the ramblers tend to underperform.
Fascinating. Oh my gosh, that is so cool. Okay, so let's take that a bit further, go back into sort of the world of quants, of the discussions actually of factors. Factors are building blocks that you'll use to sort of get where you need to go. Mike, take us into the world. I'll ask both of you this, but just sort of which factors have been most useful lately, perhaps, and what you see, any changes on that horizon. Mike, you first.
Yeah, so I think one of the things just in terms of our philosophy and perspective is I think factors through time can be cyclical. So some can work very well in certain environments, some may underperform in other environments. And so the way that we've built our model in terms of thinking about companies from a long-term investment perspective is we've got a diversified view, lots of different factors in terms of evaluating companies, almost in the way that you think about asset allocation in terms of equities, fixed income, commodities to create that better risk-adjusted return. We think of factors in that same way in terms of creating consistent returns over many market environments for our clients. So we're looking at growth characteristics, we're looking at valuation type characteristics, we're looking at momentum characteristics, and then we've got non-traditional areas that we're looking at short interest in a company or what the option market is telling us about a company. Recently, where we've seen more power or efficacy in our model, I would say, is in some of those momentum factors. So catching on to some of the trends we're seeing in semiconductors, for instance. I think what's interesting is when we think about momentum characteristics or factors, folks that are familiar with factor investing will say, well, momentum over time, like it works, but then all of a sudden you can see a pretty sharp reversal. And we're starting to see some of that in terms of our model, meaning high momentum companies that we see, they're actually starting to see a little bit bigger impact in terms of more short interest in them. And the nice part about that is when we start to see higher momentum companies in our portfolio, we start to see some of those other non-traditional areas be contrarian to that. we're going to start to move some of our exposure away from that. So there's sort of this natural checks and balances from this diversified view. And so hopefully if, the trend following companies start to see a reversal, we're in a lot better position because of our diversified view. And I think that goes to many different aspects of our model and how we think about building it.
It's fascinating. Anna, to take us through a little bit the rebalancing, the discussion of where that comes in, how you do that.
So we run our process every day. Every day that data is being updated, companies' prices, trading information, they're having earnings calls, updates to their financial statements. We update every day, and we know every day how each stock's expected return and risk profile is changing. We trade several times a month, and that is determined by how much of the expected returns of the stocks have changed. And so if we do see large changes, we want to incorporate that into our model. But we do have a very rigorous, systematic portfolio construction process. We do what we call a mean variance optimization, which ensures that we're meeting all of our risk guidelines, but doing that by owning stocks that have high expected returns.
Okay. That's really, is there anything to add there, Mike, just on sort of what investors want to know? Ultimately, this would be, you're working towards something that's quite core. What is the rebalancing story there?
For me, it's steeped in objectivity, right? So we've spent a lot of time in the research process. We've looked and tested a lot of the characteristics that we want in terms of the companies we own over, 10, 15, 20-year multiple market cycles. And so when it comes to implementing and trading the portfolio, we want to maintain that discipline. We want to honor the research we've done. We don't want to go in and start to make discretionary decisions outside of that process. And for us, that is going to lead to the best results for our clients. And that's how we're set up to manage this strategy. And so it's very systematic in nature. And it's really following the research that we spent a lot of time doing.
Anna, when we spoke a couple of years ago, I think, we were actually talking about, it was sort of in the scope 3 discussion of supply chains and ultimately where things are coming from a commodity basis, companies that are invested. This was in soft commodities. We were talking about chocolate, actually. Mm-hmm. And you were telling us a little bit about how certain companies, when they are calling on cocoa makers, ultimately can sort of give back to the community as a form of the overall impact that they're making, a good impact in that sense. And actually at the time, I think you said something like, but then you have to think about how the company would do those nice impact investments if the price of chocolate went down. The price of chocolate has just rocketed, as we all know. So I just wanted to check back in with you on something like that. But it's a good example of what companies can do. Take us through.
Yeah, absolutely. So, one of the most important parts when we're evaluating a company's sustainability is the sustainability of its supply chain. And that's actually a very big part of the evaluation. And so, during COVID, for example, is really an opportunity for companies to reevaluate their supply chains, make sure that they were pandemic proof, but also gave them an opportunity to really make sure that they were had as their suppliers, for example, companies that were also sustainable. And so this is where the chocolate example comes in. Cocoa is critical to making chocolate. That's what chocolate is. But where does it come from? It comes from cocoa farmers who are primarily in developing countries. And so to ensure that these chocolate companies have a consistent and reliable supply of cocoa, they can help these farmers, not just financially by buying from them, but also by educating them on better farming techniques. They can set up schools for their children. So by looking at their supply chain, not just from a financial perspective, but also from a perspective of how can they improve the lives of the farmers, they can actually have a much more rigorous supply chain and then themselves be a much more sustainable company.
Yeah, fascinating. I was going to take it to you, Mike, a little bit on, some thoughts on demand from investors ultimately for this form of investing, and maybe adding on to that, at what point does this become commonplace? I mean, do you have comments on that one way or the other? How do you see that developing?
Well, I think it can become commonplace in the sense that some of the sustainability measures that we look at today, I think they are going to be intertwined with some of the traditional financials that we look at or have historically. Meaning, if I think about energy, for example, why does sustainability measures matter? Why does energy transition matter there? Some of the companies that are going to be better suited for the future are those that are already making investments in that transition today. So there's less risk of having stranded assets. So proven oil reserves may not make sense to take out of the ground. So that is sort of one example of, if you're looking at a company's revenue from an energy company's, we look at it in different ways. When we evaluate companies, we're looking at how much are they putting in research and development? How have their intellectual property patents grown over years? And so those companies that have more investment in that today, that are also meeting sustainability measures today relative to their peers, those are going to be really good companies for the future as well as we move into this energy transition, right? So we've got 2050, 1.5 degrees Celsius in terms of what we want to achieve for temperature rise. That's going to mean less fossil fuels. We want to be invested in those companies that are going to make that energy transition, right? So I think that's a good example of the sustainability measures and metrics that we're using I think, becoming more mainstream as time moves on.
Yeah. Anna, anything to add to that?
Yeah. Actually, I have another example, which I think is really important, and that is a huge part of sustainability is governance. And I think one of the lessons that we learned from COVID was that, companies had to scramble to sort of, adjust to the dynamic workforce and closures and issues with the supply chain. One measure of a high quality company is the quality of the board. And if the board is overboarded, the question is, how many other boards are these board members sitting on?
Oh,
So you can imagine if you have a board and its members are on lots of different boards and there's another pandemic, these people will be stretched very thin. So what you want is, you want a board, yes, you want them on some other boards, but not too many. You want the board to be independent. So looking at metrics like this, they're generally what I call quiet metrics. When there's no pandemic, there's no global crisis, a company can frankly have a poor board and still do quite well. But when there's an emergency, when there's a crisis, that's when you need the high quality board. And so even though you may not be rewarded for years in terms of really focusing on having a high quality board, when it matters, it really matters.
That's really fascinating. Yeah, we sort of pandemic proofed everything. And as you say, those are one of the lessons from that period. Mike, we've talked about factors. We've talked about different types of data, different types of measurement. Can what you do apply to, it sounds like it can, to every sector? I mean, can you go from healthcare to energy to, is there anything that you cannot invest in?
No. So the way that we've designed this portfolio is definitely to have a broader application, right? So we want this to be a core equity exposure, but we want to select best in class sustainable companies. So we are going to have exposure to the energy sector. We are going to have exposure to utilities. Part of that is, when you think about this being, within an asset allocation, it would be, I think, disappointing from a return perspective. Quarter to date, energy's done really, really well. You don't have that in your portfolio. You might be falling behind sort of the main market. So again, we want to be closely aligned to that core investment sort of offering. I think if you think about, restricting that, if you wanted to meet, the Paris Climate Agreement goals, you're taking away like half of your investment universe. There are companies that aren't going to meet that today. So I think we want to be sort of strike the right balance between companies that are going to lead us into a sustainable future, but then are also going to reward investors in terms of getting them returns that are going to help them in their financial goals. And that's part of what we're trying to build in this portfolio. Like, the portfolio does have, when we think about some of the supplemental metrics that we look at, is less carbon intense than the index. It's got more revenues coming from clean energy. It's less water intense. And so that's the goal of building that. But we're doing that and representing it across all of the sectors and countries.
Okay, so it's so fascinating. Anna, what ultimately would you say, just kind of coming back to the machine learning and how you apply that to what you're doing, and in a way, how you see that changing over the next little while? I imagine it'll only become more and more part of what you do.
It will definitely become more and more a part of what we do. We've been doing it for years. Frankly, the machine learning techniques we're using right now are very traditional. These are mathematical techniques that have been around for decades. We are a little slower about adopting things that are more cutting edge, like the more recent advances in AI, because we want to take the time to learn them and study them and understand them. I think Mike talked earlier about the importance of having an economic rationale behind everything we do. Well, there's also an economic rationale behind things like machine learning. It may not be a story that is easy for us to tell, something around behavioral finance or some behavior around children. It may not be that straightforward. When you're talking about things like AI and machine learning, the economic rationale comes from really understanding the mathematical technique and applying the right one, understanding how to properly clean the data to make sure that it's not garbage in, garbage out. And so it's really, we've opened up this whole new area of quantitative investing that requires slightly different skills, slightly more technical skills. But investing is very competitive, and to stay ahead, it's these more cutting edge techniques that allow us to stay ahead of the curve.
Fantastic. And Mike, I'll just sort of let you wrap it up. It's kind of the way we began it, but the idea that all of these additional lenses, which have grown since last time we spoke, are allowing for something that, again, is more sustainable as an investment.
That's right. I mean, as Anna pointed out, there's a lot more data at our disposal today, and that to us, we can, create a better strategy going forward. That's part of our philosophy, right? Is to continue to add to or enhance the overall process through our research. And again, the overall objectives of this portfolio are not going to change, right? So it's, again, creating that advantage sustainability profile, and then out of those securities that meet that criteria of being sustainable and how we're defining that, within that subset, picking the stocks that we think are going to be the best performers over the long term. And again, the overall goal of this strategy is to align our portfolio to those investors that truly want to express a value in terms of that sustainability, but not necessarily have to give up on the return side in achieving that.
Fantastic. We'll leave it there. Mike and Anna, great to catch up with you. Thank you for your time. Enjoy.